Hi guys, my name is Tom. Welcome to our first video. We are so excited to start this video series. Over the course of weeks and months, we are going to teach different option terms, strategies, and techniques to our viewers. Our ultimate goal is to educate you about the wonderful and highly profitable world of option trading. As always, don't forget to click the link above to subscribe to this page and receive alerts when they're posted. So let's jump into our first video and let's start with the basics. What are options? Ironically, for explaining options, we need to go back and look at the terms, what is a stock? Once you understand what a stock is, then you can understand how an option contract works and how options are traded and go on from there. So a stock, which is also known as an equity, is a security that represents ownership of a fraction of a corporation. This entitles the owner of the stock to a portion of the corporation's assets and profits, equal to how much stock they own. Stock investors earn money in two ways: capital gain or dividend. So capital gain, if you sell shares at a higher price than you originally paid for them, you bought it at $1 and up to $10, will show a net profit after deducting trading or other associated costs. You've made a capital gain. On the flip side to that, if you buy a stock and it goes down, you bought it at $10 and it goes down, you've got a capital loss. And that's important, especially when you get into taxation reasons. The next one, dividends. This is the distribution of a company's earnings passed to a class of its shareholders. Usually dividends are paid quarterly, monthly, or semi-annually. So that's how you make money on stocks. Now, how does this have to do with options? Well, options are contracts that give the bearer the right, but not the obligation, to either buy, sell an amount of some underlying asset at a predetermined price at or before a contract's expiration date. What does that mean? Okay. Option contracts are financial agreements between two parties to facilitate a potential transaction on an underlying security at a set price called a strike price prior to an expiration date. When you buy an options contract, you are choosing to either exercise your options contract on or before the expiration date, or simply allow the option to expire unexercised. Options are an example of derivative. So a derivative price is determined or derived from the price of something else. Wine is a derivative of grapes. The price of wine has factored in the cost of the grapes. Fruit juice is a derivative of the underlying fruit. Now, finally, options contracts are derivatives of stocks. What you're doing is you're trading the value of stocks without actually owning the stocks. You're trading a contract, which is called an options contract. So there are two types of options contracts, which is, very simple. Once you understand these basic two, all the complex option strategies that we're going to talk about down the road, iron condor, iron butterfly, they're actually only made up of these basic two simple options. So a call option is purchased if the trader expects the price of the underlying stock to rise within a certain time frame. Flip side to that, a put option is purchased if the stock trader expects the price of the underlying stock to fall within a certain time frame. Call, rise, put, decline. Now, what are some important points we all need to understand about options trading? All right. These are some very, very important points you've got to always remember. One option is called a contract. So when people talk about contracts, one is called a contract. And each contract represents ownership of 100 shares. For example, if you buy and sell 2 contracts, what's your position? Your position tracks the movement of 200 shares. If the option expires in the money, it has value, then the owner has the obligation, but not the right, to buy 200 shares of the underlying stock, because he owns 2 contracts, 200 shares. Now, it's important to remember that one option contract equals 100 shares because it magnifies the returns in both the upside and on the downside. An investor can earn virtually unlimited upside. However, they also can suffer 100% loss if the price does not move in the intended direction. Let's say you buy an options contract, a stock goes from $5 to $10. If you just bought one of those shares, what did you make? You made $5. It went from $5 to $10. But this is an underlying options contract. It went from 5 to 10. Well, that gets magnified by 100 times because you own 100 shares. So you could potentially earn up to $500 in that investment. So that's how and exactly why people are very attracted to options contracts, because if you're right, you can make a lot of money. But also highlight, if you're wrong, you can lose a lot of money. It's called much more than stock trading. So stock traders purchase, we talked about earlier, they purchase a small ownership in a company. However, option traders are essentially purchasing the right to buy and sell shares of the underlying company for a set price in the future. However, as highlighted here, there is no ownership of the company. That's an important point. So option traders do not have any ownership. So therefore, they do not have the opportunity to earn dividends or vote, which are two, the easily distinguished aspects between being a stock owner and an options owner. Also, with an options owner, your contract will eventually expire, which I've talked about all the times. Stock trader, you could essentially hold it forever. When you buy an options contract, it can be broken into a simple term. When you buy an options contract, you're essentially betting on which way a stock will move without having to own the underlying stock. So that definitely promotes positives and negatives, but you are not, it's not betting as in, Casino Royale, but it's an educated assumption on where the market's going to move based on your research, your fundamental and technical analysis, and you investing your research to get yourself a position. So that is what an option is. So it's kind of very, very simple when you break it down like that. Thanks so much for watching our first video. It's been a pleasure. Don't forget to subscribe. This has been a great video showing you what an option is. If you like this page, please click on our website at the link above and below, as well as our social media accounts. Stay tuned for new content next week, and I'll see you later. Thank you.